I'm really pleased to welcome you all and pleased to introduce our speaker, Fabienne Schneider. She works in financial markets department at the Bank of Canada. She recently received her PhD from the University of Bern, but this paper is not her job market paper. It's actually impressively very new paper that she managed to develop during her first year post-PhD, as I understood. So today she will present the paper titled Security Lending Facilities from Last to First Resort, Evidence from Sweden. And I'm confident this paper will attract strong interest across our network, and women in finance with different expertise would be interested. So it definitely should appeal to all of us who work in policy. And I'm sure there will be as well lots of engagement from asset pricing expert and market microstructure academic expert, because the data that they are using is really impressive. Yeah. So I stopped spoiling the paper, and now the rules of the game. Yeah, so we have like 40 to 50 minutes, depending on the questions. So the clarifying questions are allowed during the presentation. Just don't forget to raise your hand. But if you have like more, follow up, more conceptual discussions, so please keep it towards the end. Yeah. And we will finish at 1:15. Okay, the floor is yours, Fabienne.
Thanks a lot, Iryna, for this very kind introduction. I feel very pleased and motivated now to present our project on the securities lending facilities. So this is joint work with Mariana Blix-Grimaldi and David Westin from the Swedish Riksbank. I myself, as already pointed out, work at the Bank of Canada, and therefore the usual disclaimer applies. And before I start, I would like to say thank you to everyone who finds today the time to attend this seminar. Okay. So the core job of a central bank is to maintain price stability such that we do not have too much inflation and such that the central bank can support the economy. Alongside changes in the interest rate, which is their main tool to conduct the monetary policy, central banks also deploy other instruments, and one of these is so-called quantitative easing, or shortly called QE. So given we have all different backgrounds, let me quickly point out what is QE. So QE is a policy in which the central bank creates money, because as a central bank, it has the capacity to do this. And with the money, it buys large quantities of assets. To illustrate this, I show you here in the figure the balance sheet of the Riksbank. And as we see, as soon as the Riksbank started to conduct QE, which it started to do so in 2015, we see how sharply the amount of assets has been rising on their balance sheet. But QE is not without side effects, and there are important side effects we must take into account. So one of the side effects is that QE can impair market liquidity. So what does this mean? So because the central bank buys a lot of assets from the private market and takes it on their balance sheet, the assets are not available anymore in the market, and dealers have problems finding the assets, with ask spreads widen, etc. And so the authority has come up with supportive tools such that they can ease those strains in the market and make sure that even during QE, the market is still functioning properly. And so one of these tools is the so-called securities lending facility. And this is our main point of focus in this presentation today. So what is the securities lending facility? The primary goal of such a facility is to address temporary shortages of government securities by letting so-called primary dealers borrow them from either the central bank or the debt office. In Sweden, it is actually the debt office. So I show you here the volumes of the Swedish securities lending facility, just that you get a feeling for how large and how important this facility was. So I plot here the volume of the securities lending facility of Sweden as a ratio of the overall outstanding volume of bonds in Sweden. And so what do we observe here on this first graph on the left-hand side? We see that before QE was conducted, the facility had a volume of around 2.5% of the overall outstanding bonds in the economy. But then with QE starting in 2015, this volume quickly went up and as high as 7.5% and later even 10% of all outstanding bonds, government bonds in the Swedish economy. So this is a very large amount because these are the daily transaction volumes in the facility. And then on the right-hand side, I also plot the facility volume with respect to the QE holdings of the central bank. And here we also see a share at the peak of around 20%. So as well, this points to the fact that the impact of the security lending facility was not negligible. But this might all sound very positive, but it is not without controversy to use such a securities lending facility. So why? The QE itself, it buys assets away from the market, and it does so on purpose to implement its monetary policy. But on the same time, then the securities lending facility actually lends the assets back into the market. And one could also think of if this facility then does not directly undo again what the central bank tries to implement. And therefore, there are different opinions within central bankers if the securities lending facility now helps to transmission the monetary policy or if it actually hinders it. And so what we try to achieve with this project is to do our contribution and look at what factors drive facility usage and how did QE affected facility usage. So how do we achieve this? So Iryna already made great marketing for our project, because what we have is a confidential, highly granular transaction data set from the Swedish facility, which is available over a uniquely long time period. So they have active facility usage in between 2002 and 2023. And we believe that there's most probably no other major central bank in the world which has active facility usage and available data for such a long time horizon. In addition, our setup, to make some more marketing for it, to convince you. So in addition, we think our setup is also ideal in the sense that the facility in Sweden is run by the debt management office and not by the central bank itself, which is not always the case. Quite often, the central bank runs the securities lending facility itself, as for example, at the Bank of Canada. But here, for our exercise, this helps because the two institutions take their independent decisions and they also have different goals. Then what do? We match the facility data, the transaction data with the QE bond purchases and also with private market financial data. And we do it all on a bond by bond basis to make our analysis very granular. Then lastly, we use a search model to also rationalize our empirical findings. So in the next step, let me give you a preview of the results so that you see what we are after. So first, we analyze so-called flow and stock effects. So the flow effects show us that the QE, the quantitative easing purchases of the central bank, led to a substantial increase in facility usage, which corresponded to around roughly half of the size of the purchases. Also, we observe stock effects. So a 1% increase in the central bank's QE stock of assets led to around a 5% increase in the facility usage. So the stock effects speak to this scarcity channel that the central bank was imposing on the economy by conducting QE. Then lastly, we also have something we call ourselves an announcement effect. So we use the fact that the central bank always pre-announced the bonds they're going to purchase a few days later in an auction. And we show that if the central bank announced the purchase of a specific bond, that the SLF usage to borrow that specific bond went up in the following days until the auction took place. So primary dealers were proactively borrowing the assets from the facility they knew the central bank would be going to buy. And this is another interesting channel next to the scarcity channel we are going to discuss. Then we have some interesting results also on the pricing. So because we have insight also into the repo market book of one of the 5 primary dealers in Sweden, which are the main market participants, we can show that the repo market rates, so the relevant secured lending rates, were going down to the floor rate, which is the SLF rate. I explain you the details later on this. Then we also show that the decrease in the facility's penalty increases facility usage. So this is just natural. So what do I mean with penalty? With penalty, I mean how much more expensive it is to tap the facility compared to the private market. Because in general, the facility should just be a lender of last resort, meaning that the price to access the facility should be enough higher such that day-by-day usage should be discouraged. But as we see in our project, at least currently, the facility is not a lender of last resort anymore, and we are going to discuss the impact of this effect. Then lastly, we also showed that dealers substituted among different security lending facilities, depending on which of them was the cheapest to access. And this is just a natural behavior, but it also shows that primary dealers are actually very sensitive to the prices and they react when price changes. Then we have also documented a rolling effect. So unfortunately, we don't have the time in this presentation to show it, but just still to point it out. So we show that as soon as QE started, primary dealers started to roll much more often their contracts with the facility. So what does this mean? To roll a contract means that if you, for example, borrow an asset overnight, so you would need to give it back tomorrow, then they decide tomorrow that they want to add another day. And so they roll over their contract and they do it for another day and another day. And before QE was taking place, this rolling behavior had an average of around 1 to 2 days. But suddenly, as QE started, this became to an average of around 15 days. And so we're trying in our project, so we're trying to explain what made this change in behavior that they suddenly wanted to roll these assets over such an extensive amount of days. So these are our empirical results. And now let me come to the theory part of our project. So we are using a search model to explain why market frictions lead to facility usage, despite its pricing is set to discourage routine usage. So this speaks for this lender of last resort motive that should prevail, but as said, currently this doesn't seem to be the case. And we use our model to explain why there is facility usage. Then we also explain why announced QE purchases increased facility usage and why there is a negative relationship between this penalty rate and the usage. And we also show why secured lending rates decouple from the policy rate during QE, which potentially hinders monetary policy. Lastly, we also explain why the facility rate became the de facto floor during QE using our search model. Then to close the introduction, we add to various strands of literature, most importantly, the one on securities lending facilities and the one on QE and market functioning. Okay, let us go over to the empirical results. So the main goal of our project is to explain the interactions between QE purchases, facility usage, and the so-called repo market. So given that not all of us might be familiar with what is the repo market, let me give you first some more details before we go into the data. So the facility is the main outside option for primary dealers when they cannot borrow an asset on this so-called repo market. And that's why it is important for us in our analysis of what drives facility usage to look also into the factors in the repo market driving it. So the repo market is the market where institutions borrow and lend cash to each other against high quality collateral. The price at which they do is the so-called interest rate, which is called the repo rate. Importantly, later for our theoretic model, the repo market is an over-the-counter market. So what does this mean? An over-the-counter market is a market where there's no centralized exchange. And therefore, there's also not one price which clears supply and demand in the market. You must more imagine an over-the-counter market as a market where, for example, primary dealers call each other and make deals with each other. And therefore, the deals can have very different prices, also depending on the relationships the primary dealers have with each other. And this OTC market or over-the-counter market frictions will become important for us when we explain facility usage in our theoretic model. Then the facility, as already pointed out, provides an important outside option for the lenders in this repo market, because as said, if they cannot find a specific asset in the market, they can go to the facility and borrow it there. They must leave a cash deposit or some other assets to do so. But then if they do so, they can get a specific ISIN. So the ISIN is the number of a specific bond. The interest rate in this market is set at a fixed spread below the policy rate, and this fixed spread is determined in Sweden by the Debt Management Office. So it's the authorities who set the price for accessing this facility. All right. So this should give us enough institutional knowledge to come to the data part. So first, we have access to the data showing all facility transactions between the horizon 2002 and 2023. Then in addition, we have the QE government bond purchases and central bank holdings on a bond-by-bond basis and per day. With respect to the repo market, we have the volumes by dealer and counterparty, and we only look at the repo trades where a Swedish government bond was the collateral, because also in the facility, you can only borrow Swedish government bonds. So this is our point of focus, therefore. Then, as already pointed out earlier, we have this repo book of one of the large primary dealers operating in Sweden. And as I said, there are only 5 of it. So in that sense, we have enough information to say something about the repo market yields when having the information on one of these books. And then we add various other data. So for example, the outstanding volume and issuances of each bond, for example, to add them as control variables in our regressions. So what is our first analysis we do? So we analyze how facility usage changes due to the quantitative easing policy of the central bank and due to changes in its relative price. So what is the relative price? So the relative price is the spread I have plotted here in this upper graph. So it is the difference between the repo market rate and the SLF yield. And what does this spread tell us? This spread tells us how much more expensive it is currently to access the facility compared to going to the private market and borrow the asset there. So we see that this spread can be up to 50 basis points, which is a spread which should really discourage day-by-day usage. But nevertheless, we still observe that, for example, during times where the spread was still 20 basis points, there was high facility usage. So here to the extent of 20 billion kroner, which is around 2 billion US dollars. And additionally, another thing we observe is that as soon as QE started in 2015, the spread was more and more pushed to the floor. And this is because the repo market rates were going near the facility rate and sometimes were even reaching the floor, meaning that they were equal to the facility rate. And this is very interesting, and we will also explain why this is the case in the CEPR part. So the repo market rates were not following anymore the central bank policy rates, the target rate, but they were following this floor by the facility. And in general, we see a negative relationship between the spread and the volumes. So in the first regression, we regress the volumes of the security lending facility as a share of outstanding volumes on the holdings of the Riksbank, the purchases, and the premium. So the holdings are the lagged Riksbank's holding as a share of outstanding volume. The purchases are the current purchases, also as a share of outstanding volume. And the premium is the difference between the SLF yield and the policy rate. So this is similar to the premium I have explained you just beforehand. Importantly, we do this on a bond-by-bond basis, and therefore we have this small I here in the equation. Then we add also a bunch of control variables just to mention. So we have, for example, issuance and repo market activities as important control variables. Okay, so what do we observe? So first we look at this so-called stock effect. So how did increases in the Riksbank's holdings of assets because of QE affect how often the market participants were tapping the facility? So we see that a 1% increase in the holdings of the Riksbank. Yes, I see the question. Let me just finish the sentence. So we see that 1% increase in the holdings of the Riksbank were increasing the facility volume by around 6%. And this speaks to the scarcity channel, meaning that when the Riksbank was more and more buying the assets away from the market, the more and more the primary dealers came into need to tap the facility and to get their assets there. Yes, Iryna, I'm happy to hear your question.
Clarifying as promised.
Yeah.
So the frequency of this regression, is it after each auctions, the Q auctions, as I understood, they are weekly, no? Or so like, yeah, how do you relate this? It is like, you know, after each auction, you have this regression. Is it daily? Is it weekly? Is it what?
Yes, so the regression we run is monthly. We take monthly averages of the variables such that we get rid of some market noise, but we also tried out daily regressions, so having a frequency of daily, and then the results did not change quantitatively.
But if it's months, I'm thinking like, so how often the SLF rate is set, yeah? Could you have some endogeneity there if you go into the lower frequency?
Yeah, so this is actually a comment we already received otherwise. If there's an endogeneity between the premium and the SLF volume. So first, the premium here is the difference between the target rate and the SLF yield. So it's not the same premium as shown beforehand, but we also run the regression with this other premium, which is the market rate of the repo market and SLF yield. And there, I think it's legitimate to ask if there's endogeneity issues. But nevertheless, we think that this should not be a problem because the repo market in general is enough large that it should not be affected directly by the SLF volumes. And so we argue that the premium should be not directly affected by the facility. But we will try to find some good instrument as well to make this even more robust. Oh, I see now Mariana, my co-author, has also joined the call, so maybe she can add something to the question.
Yes, so can you hear me first of all?
Yes.
Yeah, okay. So the way in which the premium is set is just like a fixed premium to the policy rate. So once this premium is fixed, you know, it will change only when the policy rate changes. So it's exogenous completely to the repo market. When it comes to the difference between the SACE premium and the repo market yield, this is what just Fabienne mentioned. We think that this is still, fairly much exogenous, because now we have the part that is fixed by the DMO that is exogenous, and then the part that comes from the repo market yield, which is affected by demand and supply of the repo market, and the volumes of the SLF is way too small to really impact on the wider market. So I hope this answer your question, Iryna.
Yeah, it does. But I still think, like, to avoid this, like, potential, link endogeneity to the policy rate changes, and hence SLF rate changes in response to policy rate, if you switch from monthly to weekly, frequency, maybe it would be, even cleaner.
Okay, that's a good suggestion. Yeah. Okay, we can definitely do this. Yes. Thank you.
Thanks a lot, Mariana, for clarifying. So let us then move on to the next regression in terms of time. Or let me quickly actually just conclude here, because I think I was actually finishing only with the stock effect, but we also have the flow effects, which basically show higher Riksbank purchases, increase facility volumes. And I told you in the introduction that actually half of the purchases were, in terms of volume, borrowed from the facility. And then we have just discussed this premium. Here we also see a positive effect, which is just natural in the sense that if the facility becomes cheaper, then we also see that primary dealers use it more often. Okay, then let me come to this cool analysis we have on the announcement effects, which are very granular. So as I pointed out beforehand, the Riksbank always announced the purchase of the assets beforehand. So every Friday after market closure, when they wanted to do QE the week after, they sent out their announcement which of the ISINs, so which of the bonds they're going to buy the next week. And so what we were interested in is finding out if the primary dealers already proactively were borrowing the assets in the facility because they knew that on the Thursday after, so the day when the auction then took place, they could sell the assets to the central bank. And their hope was that they could maybe sell these assets at a higher price to the central bank, and that they could then afterwards rebuy them on the market to give it back to the facility. Because importantly, remember, the facility is just to borrow assets, you don't purchase them. So we do separate regressions for each day between the announcement and the auction, as well as for the auction itself. And so what we observe here is a positive coefficient for every single day. So this means that the primary dealers did this trade where they borrowed the assets such that they could potentially sell them back to the central bank on the Thursday afterwards. It must not even have been for their own profit, but it could also have been for the profit of their clients who might have asked for doing this trade. Nevertheless, keep in mind that this is not without risk. So it is not a pure arbitrage story here, because they never know at which price they can rebuy the assets on the market. Okay, so with this, I would close the empirical part out of time reasons and would go over to our model part. So the theory. So we set up a search model to rationalize some of our empirical results. And I would like, with the first 4 slides, give you an insight into the model setup and then explain you in a very intuitive way, given the short time we have, what are our results. So we have a deterministic infinite time model with 2 subperiods each period. So we see this here on the timeline. In the first subperiod, there is always a so-called repo market taking place, and in the second one, a spot market. We have a mass 1 of infinitely lived primary dealers and 1 central bank. There's a stock of assets and money in the economy, which is, of course, important when we want to talk about QE, because QE will affect their stock directly in the sense that it will increase the stock of money in the economy and decrease the one of assets. And then, in addition, primary dealers can also produce and consume a so-called spot market good during the spot market. So this good just helps to settle the trades. And therefore, we add it in this economy. The production of it gives them linear disutility and consumption linear utility. And the linearity helps us that there are no wealth effects. And this will imply that if we have a distribution of money and assets over the time, then the linearity will make sure that because there are no wealth effects, we can reset basically the economy in the second subperiod. So let us go through the markets and also the shocks we have in this economy. So there's the spot market, and trade there is frictionless. It's frictionless all-to-all trade. There's no over-the-counter frictions. Primary dealers can build up or decrease their asset and money holdings at the spot market good at price Q or for money price phi. Then at the beginning of each period, a share mu of primary dealer receives an exogenous demand shock. So what does this mean? This means that primary dealers can gain utility kappa per asset held at the end of the repo market. So how can we interpret this shock? Because this seems pretty abstract, right? And we want to just have what is necessary in the model, but to build the story, we want to give it some interpretation. So we can interpret this shock as an investor asking a primary dealer to borrow assets on his behalf. And then the kappa would basically be a reimbursement for a convenience yield the investor receives per asset. Then the primary dealers who receive this shock, we call it of type I equals 1, and all the others, we call it of type equals 0. Then going on, after the period started and the shock hit, we have a bilateral market, which is this repo market. So this is the center of attention, and we want to have, or we want to analyze the interactions between the repo market and this facility. So in the repo market, each primary dealer of type 0 matches with one of type 1. They maximize their joint surplus by lending money to each other, and importantly, these trades always have to be collateralized, and they also have to be reversed the next subperiod. And this collateralization and the reversion in the next subperiod basically makes it a repo trade. Then the value of the collateral is set as such that it is taken from the spot market. So the price is set to this equilibrium value Q. So they take it as given in the repo market, which seems to be a natural assumption. How is the repo rate determined in this market? So the repo rate on borrowed assets is determined by the primary dealers bargaining with each other. So we can imagine they call each other, and then on the phone, they say, okay, which collateral are we talking about? What amount of money? And then they also have to set this rate and determined on their bargaining power. So for the PD0, we say he has bargaining power theta. And for the PD1, we say he has bargaining power 1 minus theta. So depending on these respective bargaining powers, the rate will be higher or lower. And we say that the rate will split the surplus according to their bargaining powers. Lastly, the payment is due the next sub-period and there is full commitment. And we have no risk of repaying here. Then lastly, before we come to the results, so in our model, we have two central bank facilities. So after the primary dealers did the repos with each other, they can access those facilities before this repo market period ends. So what is their menu, basically, that they can choose from? So either they can go to the deposit facility of the central bank, and then the primary dealers deposit money and receive an interest rate RD the next period. Or, and importantly for our project, they can go to a so-called reverse repo facility or securities lending facility. So these two are the same. So what is the difference? So this reverse repo facility or SLF will pay an interest rate RF, which is slightly lower than the one on the deposit facility. But, and importantly, the trades are collateralized, so it gives you the chance to acquire the assets you are potentially in need through this facility, and therefore you want to tap it. Before we solve the model, we take a last assumption. We assume that for the primary dealers who have a high utility from the assets, so the ones who received this demand shock, for them, it is profitable to forego this small interest rate difference to acquire the assets. So this makes sure that at least some agents in our model have potentially a motive to tap the facility. But still, we need some extra frictions. And we see this now in a second. So I decided to explain you our results. The best is to go through the timeline with you. And then I can explain you on the goal how the primary dealers take their decisions and how do they decide which facility they want to access, if they want to get the assets on the repo market, or if it's more profitable to go to the facility, etc. So what is the step one? So the step one we take before the new period starts. So their primary dealers rebalance their asset and money holdings. So they basically set up their optimal inventory before they know that a shock might potentially hit them. Then at the beginning of the new period, this shock then really comes and hits a share of the primary dealers equal to mu. So here I have 4 primary dealers as an example, and 3 of them got shocked, while 1 of them does not receive a shock. So this is the yellow one. Then the primary dealers go to the repo market and they match with each other and trade the assets versus the money. So we see this here in the lower part of the slide. So the 2 primary dealers match. They bargain about the repo rate RR. So this is an endogenous object, and they exchange the optimal amount of money versus asset with each other. Unfortunately, there are these 2 primary dealers who are left without a partner in the repo market. So basically, they cannot fulfill their demand for assets. But the good news is they still have a chance to adjust their optimal asset holdings, because now in the next step, they can also tap the facility. So even though we have this situation which we call excess demand, meaning that there are more primary dealers in the market who received the shock than the one who didn't, they have still the ability to acquire more assets. And they do so by going to the facilities. So let me quickly repeat them. So the deposit facility gives uncollateralized deposits at the rate RD. Then the SLF, the securities lending facility, gives collateralized ones at the slightly lower rate. but importantly, it's collateralized, so it gives you assets. So what do the two primary dealers who were unmatched optimally decide? So given that have this high usage for the asset because they receive this extra utility kappa, they're willing to forego the interest rate difference and to tap the securities lending facility. Because optimally, they would have borrowed the assets from the repo market because it's cheaper there. But because of these frictions in the market, the OTC friction, they couldn't find the assets, and therefore they go to the reverse repo facility and borrow the assets there. Then the unmatched primary dealer, the matched primary dealer who received the demand shock does the same in case he has some money left over after the repo market. And the only one who taps the deposit facility is this yellow agent here. So he has no special use for the assets because he didn't receive this demand shock. And so for him, it's actually the better deal to deposit the money he acquires through the repo market. It's the better deal for him to deposit this money into the central bank facility at the rate RD than at the rate RF, because he has no special use for the collateral. And therefore, naturally, the different types of primary dealers separate themselves into the different consumers of the two facilities. So that's the basic setup. And we reached the first result that we have a positive amount of money in the facility, although the pricing is not speaking in favor of it in the sense that the rates are lower than the one of the deposit facility and the one of the market. But nevertheless, because we have this excess demand, the amount is positive, and it is the higher the excess demand is. OTC market friction, as pointed out, are key for the result, because in a centralized market, you would never observe that there is positive facility usage if there's this spread. Yes, Iryna. And I can't hear you yet.
Just wanted to say you have 5 minutes.
Okay, perfect. Thanks. Yes, so in a centralized market, we would never see that the facility use would be used despite this positive spread, because there the price would just clear the market, and it would do so either above the floor rate or the market rate would go to the floor, and then maybe they would use the facility because it's the same expensive, but they would never use the facility if the spread is still positive. Okay, and now we introduce QE as a last part. So QE takes place before the end of the repo market, after repo trades were conducted and facility were used. So QE basically gives the right to every primary dealer that he can sell assets to the central bank, but then he forgoes this extra utility kappa in case he received this demand shock. So this speaks to the story that he cannot on the same time deliver, for example, an asset to an investor and on the same time sell it to the central bank. So this is a natural assumption. Then also to match the data, we assume that the central bank's price is higher than the spot market price. So there is a paper by the Riksbank by Stefan Lassen, who shows that this was generally the case, which is very interesting because this gives them the potential to have some gain from borrowing assets and selling them to the Riksbank. And on the same time, we also assume that the price was not as high such that all primary dealers would have sold all their assets to the central bank, because this is a too extreme model outcome. So what changes with QE? With QE, now also the primary dealer of type 0 suddenly wants to go to the facility. So why does he want to do it? He knows that right after the central bank is going to purchase assets, and therefore he now also wants to borrow collateralized or deposit collateralized, such to borrow assets and then to sell them to the central bank. And therefore with QE, we in general observe that the amount of money in the reverse repo facility increases. And we also have this announcement effect, which matches perfectly our empirical results, that there are primary dealers who borrow from the reverse repo facility just to then sell the assets to the central bank. Then we have a last result on the repo market rates. So let me explain you this as a last step before we conclude. So the interest rate in the repo market without QE is given as a linear combination between the two facility rates, and their respective bargaining power theta will decide to which of the rates the repo market rate is closer to. But then with QE, we see that the repo rate is pressed to the floor. So we see that the repo market rate fully decouples from the deposit rate, which we can also interpret here as the policy rate. And this is interesting because there's a discussion in the literature why this happens, because in general, the authorities would try to keep the repo market rate in their corridor. But we observe actually in Sweden that even when the corridor they had for their monetary policy got narrower, still the repo market rate stayed during QE perfectly at the floor. And this result matches what we observed, therefore, empirically. So I said already what I was going to discuss on this slide. So in terms of time, let me therefore conclude. So what have we seen? So we have seen that although the Swedish facility was supposed to be a lender of last resort, there is high usage day by day. And this speaks against one of the Bagerholz lenders of last resort principles, which is lend only at the penalty rate such that the facility is only used when dealers are really truly in need. So given that the Swedish securities lending facility doesn't seem to follow this principle at the moment, we had the motivation to analyze the facility usage on a bond-by-bond basis during QE using this granular data set we have. And then in a second step, we also added this search model to rationalize our empirical results. With this, we hope we can add to the following open discussion I have already pointed out in the beginning. So QE itself tries to target long-term rates, while the facility affects the short-term rates. But we know that the long-term and the short-term rates interact. And we know that QE takes away assets from the market, while on the same time, the facility lends them back into the market. And I've pointed out to you that this is an open discussion among central bankers, to which extent now the facility helps to implement the monetary policy by making sure that the market functions smoothly, or to which extent the security lending facility hinders the transmission of monetary policy. And we hope that with our analysis of the securities lending facility, we could give some insight and add to this discussion. And with this, I would like to thank everyone for your attention, and I'm very happy to take some further questions. Thanks a lot.